AI investment boom shielding US from sharp slowdown, says IMF. The world expected the US economy to slow, but it didn't. A secret engine-powered resilience that left economists stunned. Artificial intelligence isn't just changing industries, it's reshaping the very heartbeat of America's economy. From Wall Street to Silicon Valley, one force is quietly shielding the nation from a sharp slowdown. Chapter 1. A shield for the US economy. The US economy was teetering. Analysts predicted a slowdown, inflation worries, and debt pressures. Then, AI stepped in. Billions poured into AI startups, chips, cloud platforms, and enterprise solutions. The IMF calls it a very significant AI-related investment surge, and it's reshaping the landscape. Consumers feel richer thanks to soaring equity markets. Businesses are hiring aggressively, expanding production lines, and investing in next-generation technologies. Financial conditions are easing, lending is freer, and confidence is climbing. Households spend more, expecting future gains. Still, this boom is largely promise-driven. Productivity gains lag hype, equities soar, consumption rises, but output hasn't fully caught up. The shield is strong but delicate. One misstep, a slowdown in AI adoption, or failed productivity expectations could ripple through markets. For now, AI is keeping the US afloat, fending off a sharp slowdown. But the question is, how long can a boom built on expectation sustain real-world growth? Chapter 2. US growth defies expectations. The IMF now predicts the US economy will grow 2% in 2025 and 2.1% in 2026, the strongest in the G7, even with global uncertainty. Months ago, fears of recession and sluggish growth dominated headlines. Today, AI investment has rewritten the narrative. Massive spending on AI chips, data centers, cloud computing, and automation fuels business confidence. Companies expand operations, hire more workers, and invest in productivity-enhancing technologies. Consumers benefit from a wealth effect as equity gains boost spending and reinforce optimism. However, beneath the surface, challenges remain. Productivity gains from AI are still emerging. Much of the growth is driven by perception and expectation rather than concrete output. If confidence wavers or AI adoption slows, the fragile momentum could falter. For now, the US economy is defying predictions, walking a tightrope between promise and tangible growth. Investors and households alike watch, aware that the AI shield is powerful but not invincible. Chapter 3. Tech stocks leading the charge. Nvidia, Broadcom, Oracle. They're not just companies, they're the engines of a booming AI economy. Tech stocks have surged to record highs, fueled by investor optimism around AI's potential to transform productivity and reshape industries. The market feels unstoppable. The wealth effect is real. Rising stock prices make consumers feel richer, boosting spending on goods, services, and experiences. Businesses reinvest profits, hire aggressively, and upgrade operations, creating a self-reinforcing cycle of growth and confidence. But underneath excitement, output hasn't caught up. AI promises are abundant, but tangible productivity gains remain uneven. Market corrections are possible if expectations outpace reality. Investors may pull back if AI fails to deliver measurable results. For now, tech stocks are carrying the US economy forward, creating a fragile ecosystem where perception drives growth. It's a high-stakes game. Optimism fuels spending, investment, and confidence, but the risk of volatility looms large, waiting for the first misstep. Chapter 4. Lessons from the dot-com era. History offers a warning. The late 1990s dot-com bubble created the illusion of endless growth. Stocks soared, markets boomed, consumers felt richer, but productivity gains lagged. When the bubble burst, millions lost wealth overnight. Today, AI is creating a similar dynamic. Investors and consumers feel the wealth effect. Equities are high, spending is strong, and companies pour billions into innovation. But productivity still hasn't fully materialized. The IMF cautions that we may be halfway to a scenario reminiscent of the dot-com era. This doesn't mean a crash is imminent, but the risk is real. Inflationary pressures rise as demand outpaces actual output. Confidence is fragile. AI is a powerful engine, but it's still fueled by promise. The economy is walking a tightrope, Optimistic markets and consumer spending prop up growth, but if the promise slips, the fragile equilibrium could unravel quickly. For now, the lesson is clear. History has a way of repeating itself. Chapter 5: Inflation Risks and the Federal Reserve. The AI boom isn't without consequences. Rising valuations, increased investment, and higher consumer spending are heating the economy. Inflation is creeping, threatening to outpace the Fed's target. Policymakers face a delicate balance: stimulate growth or prevent overheating. 3/4-point rate cuts have been implemented, but hitting the 2% inflation goal remains elusive. AI-driven spending accelerates demand while productivity increases. Businesses hire aggressively, invest heavily, and households consume more, creating pressures that monetary policy struggles to manage. The Fed's flexibility is limited. Too much stimulus risks inflation spiraling. Too little could stall momentum. Wealth effects and investment surges create a short-term boost, but underlying risks remain. The economy thrives on optimism, but the balance is precarious. AI fuels growth today, but inflation shadows the gains, reminding policymakers and investors alike that even the most promising technology boom carries hidden costs that cannot be ignored. Chapter 6: Trade Tensions and Global Uncertainty. AI's surge coincides with a backdrop of US-China trade tensions. Export controls on rare earths and critical minerals, tariffs and supply chain disruptions create a shadow over growth. Businesses worry, investors hesitate, and consumers feel the ripple. So far, the IMF sees limited direct impact as households and companies have adjusted spending and investments. But the threat is real. Escalating tensions could increase costs, slow production, and amplify inflation. AI investment cushions the economy, but it's not a perfect shield. Supply chains remain vulnerable, global uncertainty persists, and geopolitical risks could trigger market volatility. The US economy is strong, but AI alone cannot neutralize external shocks. Policymakers and investors must remain vigilant. The lesson is clear: domestic technological growth can protect against slowdown, but in a connected global economy, fragility lurks just beneath the surface. Confidence may hold for now, but the future is anything but guaranteed. Chapter 7: Global Growth Outlook. Global growth is projected at 3.2% in 2025 and 3.1% in 2026, slightly below 2024's pace. China leads with 4.8%, while the UK clocks in at 1.3%, second fastest in the G7 after the US. The US stands out. AI-fueled investments have allowed it to outperform peers, maintain consumer confidence, and sustain strong equity markets. Businesses invest aggressively, hiring surges, and households spend more, reinforcing the loop. But risks persist. Inflation pressures, trade disputes, and geopolitical uncertainty loom. Compared to Europe's debt struggles and China's measured recovery, the US appears resilient. AI is a comparative advantage, but sustainability depends on execution, policy, and global stability. Growth is real, but fragile, tied as much to perception as actual productivity. Chapter 8: The Future of AI-Driven Growth. AI is transforming the US economy, but uncertainty is never far. Equity gains, booming consumer spending, and surging business investment paint a picture of prosperity, but productivity gains are still catching up. Much of the current boom is driven by perception, by promises of what AI could deliver tomorrow rather than what it produces today. Market corrections remain a real risk. Over-reliance on expectations over actual performance could expose vulnerabilities. Policymakers are walking a tightrope, trying to foster innovation while keeping inflation in check. Investors juggle optimism and risk, while consumers spend on hope, not output. For now, AI shields the economy and reshapes markets, but the line between promise and performance is razor-thin. One shift in confidence, a trade disruption, or slower adoption could trigger turbulence. The AI boom has bought time, but long-term growth depends on execution, adoption, and productivity. The waves are here, powerful, transformative, and volatile. Whether this becomes a lasting tide or a fleeting surge will define the next chapter of the US economy. So, the real question is, will AI truly secure America's economic future, or are we riding a high-stakes gamble on promise and perception?